Cost allocation. Topic that we of course work in quite heavily, and it's always a discussion of debate, because sometimes people say cost allocation should not be, you should do cost modeling, but cost allocation is a term that is very widely used. The definition that we take for cost allocation is, very simply put, the whole process of getting your cost that you have in your general ledger. Usually you have it in your cost centers and cost types, that's perfectly administrated in your financial systems, but how to get actually that granular information, how to allocate, as you would, hence the name cost allocation, how to allocate that to your different departments or your different products or your different services that you provide or your different resources. That, in essence, that process is called cost allocation. And it sounds very simple as I put it now, but there are very much large numbers of different applications of cost allocations, because you can imagine that if you want to go as far as allocating your cost all the way down to your transactions, so every single transaction that you have in your company is something completely different than to allocate your cost from your CEO, so your C-level suite, to your departments, or your IT cost to your different departments. That's a whole different game. So there's a lot of different applications, but the principle of getting your cost from your administrative system where your financial accounting is being done towards your departments or products or whatever, that is the essence of cost allocation. Different methods of cost allocations. As I explained before in the definition a little bit about cost allocation, there are different use cases for cost allocation. One where you go very granular, one where you maybe just want to allocate your overhead. It's just different. And different goals that you have with your cost allocation have different methods. And different methods also have different techniques. So it's a little bit semantics here, but I'll try to have a little bit of a system here. If you talk about methods, then I'd like to distinguish on pushing cost down, so push allocations, and pull allocations. And I'll explain you the difference quite simply. When we talk about push allocations, I'm trying to get my costs from my general ledger towards the goals that I want to get them to, either to a department, either to a product, to a service, or all the way down to my transactions. Pooling your cost allocation is a little bit the other way around, because you could think in volumes. If I would have so many transactions, then through these volumes, I would actually end up with supplying so many services, and if I supply so many services, I need so many people or other type of resources, and that leads to so much costs. That's pool allocation based upon the volumes. Please note that both of them have a very strong cause and effect relationship, because you want to make sure that, in such a saying that we have around here, is that the one that pollutes has to pay, cause and effect. The one that causes the cost should also bear the effect of the costs. However, that is all nicely said and done when you're in a management accounting situation where you try to make the best decisions within your company. Sometimes you're actually driven by regulatory rules, or you're driven by financial accounting rules, or by tax optimization, and you can make different choices. Within those methods, push and pull, let us now go a little bit to another method, which is a little bit like sidestep of these methods, is when you talk about transfer pricing. Transfer pricing is where you would actually set a price of the services within your company. Say, for example, that you have an HR department, and your HR department provides services for the whole company, for different business units, maybe even in different countries. Then in that situation, you could price the HR services and sort of like invoice that, transfer pricing as it's called, towards the different business units. Well, you can imagine that invoicing those services comes with a lot of regulations, because you cannot put whatever price you want. It has to be at arm's length, as they say, or sometimes you can optimize it a little bit and have the higher prices towards business units where profit taxes are a little bit higher, but still all within the regulations. The whole transfer pricing discussion is a little bit like optimizing the situation of different business units by using cost allocation. It's just a form of cost allocation. Getting a little bit more away from the methods, like get ourselves a little bit more into the techniques. Then if you talk about techniques, the most easy techniques is just direct costing. If you know what costs are being made for what situation, I'll give you a simple example. If there's a certain department that hired some consultancy, but that consultancy was booked on an overhead cost center, then it's very easy to directly allocate that cost to the certain department who actually bought the consultancy. So that's like direct cost allocation. Then the second one is driver-based. So driver-based, relatively easy as well, is where you say, okay, what is the cost driver that determines the cost? Say, for example, again, I stick to the HR example, is where you would have HR activities being allocated based upon the number of people that work in certain departments. And it could be FTE, so full-time equivalents, but it could also be headcount. Say, for example, when an HR department is making a contract, doesn't really matter if that person makes a contract for somebody who works for 50% or works for 100%. Then headcount is probably a better driver than the number of FTE. But driver-based allocation. And within that driver-based allocation, you can have a little bit of different techniques as well. You can do that based upon a step-down approach. What do I mean by a step-down approach? I'll easily explain it. HR performs activities for IT, but IT also performs activities for HR. And a way to solve that, I personally think it's the best way, but there is a way to solve that, is to think about it in double steps. So step down, first you would allocate the cost of HR and IT to all the other support departments. So HR can allocate the cost to IT and IT can allocate the cost to HR. So you get a sort of like loaded HR and a loaded IT, and those can be allocated then again out, the second step, hence the name step down, allocate them out towards the direct department. So that's step down technique. A third technique is reciprocal. I have to put it right, reciprocal allocations. And reciprocal allocations are ones that you could actually go back and forth all the time. So HR does work for IT, therefore IT becomes a little bit more expensive, so IT can allocate back to HR. Hey, HR becomes a little bit more expensive because of the IT costs that come in there, upon which HR now allocates back to IT again, on and on. You get in sort of a loop, but that loops can be solved with mathematical equations, and there are other techniques to solve that, but the overarching name is reciprocal allocation, as it's called. And last but not least, it's not widely used, but some companies use that. It's a waterfall allocation, and waterfall allocation is where you actually set an order of allocating costs. So you would set, okay, HR first goes to IT, IT goes to finance, finance goes to office management, and then the office management is fully loaded, allocates out to the direct departments. A matter of choice, just different elements. Key principles in cost allocation. I think no matter what kind of goal you have with cost allocation, the key principle should always be cause and effect. Even if there's a regulatory pressure, even if there's a transfer pricing optimization that you're trying to do, please always get to that point where you're saying cause and effect. And what do we mean by cause and effect? What we mean by that is that you make sure that costs are being allocated to those elements, and elements can be a department, can be an activity, a process, a product or a service, to those elements that are actually causing the costs. So cause and effect. So as an example that I'd like to take, if you have your finance department and you want to allocate your cost of your finance department, try to always find a way, how can I allocate that based upon cause and effect. Say that the biggest chunk of your finance department is people that are doing account receivables or account payables. Well, if it's account receivables, then it probably has a lot to do with your sales that you have. If it's account payables, it's with all of the purchases that you're doing. So make sure that departments that do a lot of sales or that do a lot of purchase get indeed charged or allocated the most cost, cause and effect. Same with HR. If HR is very much busy with promotions, with new hires, with new contracts, make sure that those drivers really reflect the cause and effect relationship between the users of the HR cost as well as the actual cost that you have in your HR department. So biggest principle is cause and effect.